Something is deeply off in financial markets right now. The usual relationships that investors rely on to make sense of risk, valuation, and capital flows are breaking down, and not quietly. Stocks that are supposed to be boring are acting like lottery tickets. Assets that normally move in opposite directions are rising together. Entire sectors feel disconnected from fundamentals. When markets stop making sense, it's usually a warning, not an opportunity. Let's break down what's happening. Bank stocks are acting like biotech stocks. Banks are supposed to be the definition of dull. Slow growth, stable earnings, dividends, modest price moves. Instead, many bank stocks are suddenly moving 5% to 10% in a single day, repeatedly. That kind of volatility belongs in biotech, not in highly regulated financial institutions whose balance sheets change slowly. This behavior suggests short-term speculation is dominating long-term analysis. Liquidity is chasing momentum rather than fundamentals. Traders are treating banks as trades, not businesses. When safe sectors start behaving like high-risk ones, it's a sign that price discovery is breaking down. Semiconductors and AI are beyond hot. They're untethered. Semiconductors and AI-related stocks are no longer just strong, they're overheated. Every dip gets bought instantly. Valuations expand regardless of earnings quality. Entire narratives are being priced years, sometimes decades, into the future. This doesn't mean AI isn't real or transformative. It means expectations have become extreme. Markets are no longer asking, how much will these companies earn? They're asking, how fast can the story spread? That's not investing, that's narrative momentum. Biotech is being destroyed, quietly and relentlessly. While money piles into banks and AI, biotech is getting slaughtered. This is odd for two reasons. 1. Biotech fundamentals haven't suddenly collapsed. 2. Biotech is traditionally a risk-on sector. What's happening instead is capital concentration. Investors are abandoning anything that requires patience, uncertainty, or long development timelines, and piling into whatever feels obvious right now. Biotech is hard, slow, and uncertain. AI is simple, fast, and fashionable. Markets love simple stories near the end of cycles. Rising yields should be crushing gold, but they're not. This is one of the clearest signs that markets are confused. Normally, rising yields strengthen the dollar. Higher real rates pressure gold and silver. But right now, yields are rising. Gold is rising. Silver is rising. That combination should not happen in a clean, rational market. It suggests that gold is no longer being treated as a simple inflation hedge, but as a trust hedge against debt, currency debasement, geopolitical risk, or systemic fragility. When gold rises with yields, it's often a signal that investors are worried about something they can't quite define. Correlations are breaking, and that's the real problem. The most dangerous market environments aren't when prices fall. They're when signals stop working. Right now, safe stocks are volatile, risky stocks are euphoric. Defensive assets and risk assets rise together. Fundamentals lag far behind price action. This usually happens when liquidity overwhelms analysis. Positioning matters more than valuation. Markets are driven by flows, not logic. In those conditions, prices can stay irrational longer than expected, but when reversals come, they tend to be violent. What this environment tells us: this does not look like a healthy bull market. It looks like a market searching for certainty and not finding it. Investors are crowding into whatever feels safest emotionally, not financially. AI feels inevitable. Big banks feel protected. Gold feels timeless. Everything else gets ignored or punished. That's not diversification. That's fear wearing the mask of confidence. The bottom line: when banks trade like biotech, biotech collapses, AI defies gravity, and gold rises alongside yields. Markets are not efficient. They're stressed. This doesn't mean a crash is imminent, but it does mean risk is being mispriced. Crowded trades are growing more fragile. Traditional playbooks are failing. In broken markets, the biggest danger isn't missing out. It's assuming that what's happening makes sense and will keep making sense. Because markets don't stay irrational forever. They just wait until the most people are positioned the wrong way.